Does it not feel like the economic news affecting the dollar has unexplored holes in it? If you feel the same way that I do and want to hedge against a dollar crash, then listen up. My next guest is a commodities dealer with 44 years under his belt, and he's about to tell you and I what he is seeing on the horizon and what you can do to prepare. All this and more coming right now. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Dana Samuelson. Dana is the president of American Gold Exchange, a physical U.S. gold and silver bullion dealer that has done over, get this, $2 billion in sales and is just getting started. With 44 years in this industry, he's seen it all. Recently, Dana's helped to establish the industry anti-counterfeiting task force, which today assists the U.S. Secret Service and U.S. Homeland Security to protect U.S. investors from counterfeit gold and silver products entering into the country from Asia. So what does this mean? Well, this means that Dana and his team at American Gold Exchange understand the risks and rewards investors face in investing in precious metals markets and investing. And he's about to teach you and I a masterclass on this part of alternative investing. So Dana, welcome to the show, man.
Thanks, Ryan. Thanks for having me. I'm a big fan of Making Billions, and I'm honored to be on here with you. It's a real pleasure to be here with you, and I'm really looking forward to our talk today. So thank you so much for having me.
Yeah, thank you for being here. We're in the top 3% in the world, all because of amazing guests just like you. So I'm excited to talk about gold markets. This is one of the most important metals, not the only one, but a very important one on many fronts, gold and silver. Folks, this isn't just private wealth management. This is alternative investing, private deals, and we're really going to open it up on the importance of this asset and what it can do in alternative investments. So before we get into all of that, and you're going to want to tune in to the end where we have some tasty tips on all that, let's just talk about a few things here. So how did you even get into this sector?
Well, I got hired in 1980 to work in a vault that was handling a lot of physical precious metals because I could be trusted. Back in 1980, it was just like getting out of college in 2009. Nobody was hiring anybody, but because I have a family connection, I got to go to work in a vault, counting, shipping, and weighing physical silver. When silver had hit $50 an ounce and gold had hit $850 an ounce in the rockin' inflationary driven 70s. I literally started at the kitchen sink. If it was a restaurant. I got a lucky break and I went to work for Jim Blanchard in 1983, who's the gentleman most responsible for the private re-legalization of gold ownership in the U.S. in 1974. When we depegged from the dollar as a gold standard in 1971, Jim understood that would create the devaluation of the dollar over time. So he championed the re-legalization of gold ownership, which had been outlawed since 1933. And he got it done. And people asked him, well, where do we buy it now that we can? And he said, well, I'll sell it to you. So by 1980, he had the largest mail order coin company and precious metals business in the country. And I went to work for him as a appraiser of vintage old gold and silver coins. And I ended up moving up to the trading desk where I got to spend about $50 million of Jim's money every year with the industry, which was a lot back then. And I got to know all of the major dealers and players in the industry. And a couple of my peers today run U.S. Mint distributorships. So we've all come up together, and I just got a lucky break, and I painted myself right into a golden corner.
Brilliant. So, with all that experience, and yes, I've heard of Mr. Blanchard as well, very involved. Most people, he's the unsung hero. If you like owning gold, you can thank him and many others who've helped to push that forward after the depeg of the dollar under Nixon. Now, that being said, now that we can invest and own private stockpiles of precious metals and gold and silver, I'm curious, for people who are just starting out, what advice would you give to them on A, how to win, and B, how not to lose when entering in the precious metals investing game? What would you say?
Well, those are great questions. So one of the most important things if you're going to invest in physical precious metals is to have a long-term horizon. This is a market where you want to dedicate funds to for an extended period of time to really get the best rewards. You should think of it as a savings account where you're saving in precious metals out instead of dollars, which are depreciating. You want to be consistent with your purchasing, or as we call it, stacking. Most people make a mistake of buying due to emotional factors like the great financial crisis hits, so they rush in when the market's really heady, or COVID hits. The best and most successful investors are the ones that consistently allocate over time for cost averaging and portfolio building. And then you want to define the reasons why you want to own precious metals. What are your objectives? Profit, hedge against financial uncertainty, have instant liquidity because gold and silver are among the most liquid investment items there are. You want to have something that has no counterparty risk, private transfer of wealth. What gold really is an insurance policy for the rest of your assets. Once you have it in place, you don't need to keep writing that check over and over again like you do with your health insurance or your car insurance. And it's performed well when it was needed the most. So have a long-term viewpoint, be consistent in your purchasing over time, cost average, and don't get emotional about when you're buying or selling. Define your goals, your objectives, and stick to them.
Brilliant. So those are some easy, when you're just starting out, really understand what you're doing and make sure that this is not a get rich quick, but almost like you said, an insurance play on the wealth you've accumulated to this point and beyond. Now, that's not enough to just capture upside. There's also some downside risks, especially when you're starting out. You may not be able to see all of those downside risks. So for someone who's been in the game for 44 years, you might have seen some things. All kings have scars, brother. What would you suggest to people who are just starting out, may not have the exposure to the risks or the experience that you have? What cautionary tales can you tell them?
Well, the most important thing to understand is that we are not a regulated industry. So anyone can be a precious metals dealer tomorrow. And we do have opportunists that come into our marketplace who are more interested in earning a profit from you than having a long-term relationship with you. So you want to find a dealer who's been in the marketplace for a long period of time. I would recommend 30 years or longer because we've been in feast and famine markets. This is our industry, our profession, and helping our clients is really what's best for us. So it's very important that if you're going to buy and sell physical precious metals, that you get in with the right dealer to start with. Drill down on the reputation of the individuals behind the business. You see any red flags? Run. There are plenty of other choices. Number two, you should stay on the main road. Most people, all they really need are a couple of different items for physical precious metals. U.S. mint-made gold and silver eagles, Canadian mint-made gold and silver maple leafs, or Austrian mint-made gold and silver philharmonics. These are the three most popular, widely traded, and competitively priced physical precious metals bullion items in the world today. We do see some premium differentials at time when there's an excessive demand. The U.S. Mint in particular cannot keep pace with demand because they don't make the blanks that the coins are struck on. So that's why we have two alternatives as backup. And that keeps you in a competitive buying situation when you're buying vanilla, chocolate, and strawberry if it was ice cream. And they're the most liquid and easily sellable, which is really best for you. You want to have that ease of liquidity, which is why I would stay away from gold and silver bars made by refineries. We do have a modest but growing problem with spurious Chinese counterfeits. And the bars are the most easy for the Chinese to replicate and pass off as good. Which makes it a harder item for you to sell in the future. I think there'll be settlement issues in the future with bars that don't exist today. So if you stick with the mainstream products and deal with reputable dealers, you'll stay off of two of the biggest minefields that there are in our industry.
Man. So make sure that we stay away from bars. Are probably not the most trustworthy. Yeah, they're not horrible, but what you're saying is, I think, is some coins are probably better. They're smaller denomination, but they still hold their value. Specifically, U.S. Eagles, Canadian Maple Leafs, and what was it? Their Austrian Philharmonics. Perfect. So those are probably the most trustworthy place to start building up your assets and working on the investment side of those things. I love it.
For individual investors, that's really the best way to go. You can buy bars, gold bars or silver bars of bigger sizes, but you want to really make sure that the dealer you're dealing with is the right dealer. That's really the most important.
Man, okay. That's solid advice, especially for those who are just starting out, that can really hand off a lot of not only where to capture upside, but how to avoid some of those risks. So I guess I better slow all those gold bars I'm buying. I better slow down and switch to some of the coins. All right. So, it's one thing to talk about actually doing the deals and looking for upside and mitigating downside, but also let's zoom out a bit and look at the gold market. Talk about a little bit of what you're seeing in the market, and then we'll transition into where your opinion is and where it's headed. So what are you seeing out there?
Well, gold has been on a tear, especially this year, for a host of reasons. I've been doing this for 44 years, and usually there's one or two influencing factors that drive the gold price higher or lower that are in the marketplace at any given time. And today we have 5 of them in the same place at the same time, all propelling gold higher. None of them are bearish. They're all bullish. And that's why we see gold hitting record highs repeatedly as time passes. We just hit another new high today, in fact. So fundamentally, gold is tracking the U.S. debt higher in the big picture. Now, it's lumpy. It gets ahead of the market. It gets ahead of the debt a little bit at times, like with the great financial crisis or COVID. It's a little under the market at times, or the debt rate at times, like we were when we had a good economy in 2017, 18, and 19 before COVID hit. But fundamentally, gold is tracking our debt higher. If you think about it, it took us 200 years to get to 7 trillion in debt in 2004. We were 17 trillion in debt in 2014, more than double. And in 2024, now we're 35 trillion in debt. We've doubled again. So where's our debt going to be in another 10 years? 70 trillion? And that's what I mean by tracking our debt higher. So now that's number one. In the short term, gold tends to trade inversely to the value of the dollar or yields for 2 reasons. Number one, most of the gold around the world is bought outside of the U.S. If you have been in a country where you've had war on your shore or your currency fail, you have a gold culture, and that's Asia and Europe. We've never had that here in the U.S. So gold is priced around the world in dollars. When the dollar becomes stronger, it's more expensive in other currencies, dampening demand. And when the dollar becomes weaker, it makes it cheaper in other currencies, expanding demand. That's number one. Number two are yields. When you have a real positive yield that you can get, say, on a CD or an interest rate, treasury yield over the inflation rate, gold tends to be challenged by that because there are costs associated with holding gold, storage fees, insurance. But when the real return is negative, as we've seen when interest rates were 0 and then inflation ramped up before the Fed started this rate hike cycle, gold thrived in that environment. And also inflation is a debasement of purchasing power. So now we have an inflationary environment, right? And we have yields coming down and the dollar weakening. One of the biggest drivers this year has been geopolitical conflict. Now, when Russia invaded the Ukraine, that helped to hold the gold price up after we got a surge from COVID. But this whole Israeli-Iranian conflict has helped propel gold to new record highs as well. And neither of these conflicts are easing. They're both expanding, actually. So until peace breaks out in the Middle East, I think we have a real good bull market here for that reason. And then there's the whole de-dollarization movement that the sanctioning of Russia by the U.S. and other countries created, where countries around the world looked at what we did with Russia when we seized their assets and threw them off the SWIFT international bank transfer system. They said, well, if they did that to Russia, the U.S. did that to Russia, they can do it to us. So countries around the world want to get out of the dollar, but they can't because it's entrenched in the financial system. What they've been doing in the meantime, though, has been buying gold at record amounts in the last 2 years because gold in a vault can't be sanctioned or seized. So all of these factors are in place at the same time right now, and they're all bullish for gold. So I see gold going higher. I think it's actually headed to 3,000 in the next 2 years, maybe less. And until some of these things change, which I don't see happening anytime soon, we won't get, a meaningful correction in the gold price.
Man, speaking of that, so that goes right back to the insurance thing that you talked about earlier. Is this is a bit of insurance, not just for an individual, but for a country as well. Just the volumes are a little bit different. Instead of coins, they have tons. Right. But either way, yeah. So I'm sure, and I have no doubt the answer to this, but I'm sure if a lot of these countries are, like you said, worried about these sanctions and they're buying gold. Is that something that you're seeing through all of your channels, or what's going on the geopolitical side?
Oh, absolutely. There's been a sea change in the last 10 years, which has accelerated in the last 2. So when the dollar was the world's reserve currency backed by gold from the late 40s all the way to 2010, most central banks were net sellers of gold for this entire period. The hordes of coins and bars that they had pre-World War II, which was basically gold that was money that they took back into their central banks, they just hoarded. Following the great financial crisis and the explosion of debt, the creation of QE1, 2, 3, central bankers became net buyers of gold in 2011 for the first time consistently, and they stayed that way through 2021, 10 years, where they're buying 500 tons of gold cumulatively a year. We know this from the World Gold Council, which puts out some great statistics, which is about 15% of mine production. Well, following the sanctioning of Russia, central banks have now doubled their gold buying. They're buying 1,000 tons or more the last 2 years. And they're on pace to come close to that this year as well, which is now about a third of annual mining production. And this is a sea change in physical demand in the marketplace, which is helping to buoy the gold price, creating higher highs and higher lows when we see weakness.
Very bullish signals for sure. Now, often at 3,000 an ounce, or you're saying you see that as a strong possibility. Silver has also its uses in the market. Obviously, there's a lot of industrial uses, commercialization uses, but it also has some profitability. Because I know you're gold and silver, so for the silver bugs out there, I see you. We see you out there. What would you say as far as, since we're talking about making billions on a show like this, how does silver fit into this mix?
Well, silver actually has a greater profit opportunity right now, in my opinion. In the big picture, gold is about 95% of monetary metal, and the other 5 or 10% is, used in industry. Silver is about 50% monetary, 50% industrial use. And when we have a weaker economy, specifically in China and in Europe, commodity use is down a bit, which is, I think, holding it in check right now. But we do see, with the rise of the green movement, solar panels, electric vehicles, greater demand for silver. And it's increasing where we have now a supply deficit in that the market is consuming more silver annually than the mines produce. We've had a structural physical deficit for the last 2 or 3 years now. Samsung just the other day introduced a new battery that takes about 30 ounces of silver and no lithium, and it charges faster and holds a charge longer. So silver right now is lagging. Gold is about 30% above its previous all-time high of 1900 in 2011. Silver's been $50 basically twice. In 1980, it was $48.50 in 2011. Today, it's $30 an ounce. So it's 30% under its previous high. That's why I think it has catch-up potential that's strong. And it'll lag for a while when gold runs like it's running now, but then it'll play catch-up. And when it tends to do so, it moves hard. When the market gets behind it, they drive it high, fast. So I think silver is testing a breakout right now. I think at this price gold of $25.50 or higher, silver should be $40 or $45 an ounce, not $30 an ounce. But you do have storage considerations with silver because it takes about 80 or 85 ounces of silver to equal physically 1 ounce of gold. So there's a lot more volume and weight to consider as from a storage standpoint. And that holds it back a little bit too. Right now, silver is lagging. It's a bit disappointing, but when it plays catch up, it'll make people very happy. And I think it's trying to break out now. Over 30 is a breakout test.
Okay. Now, I was going to ask you where you think the market's going, but I think we've jumped into that. So we think 3,000 an ounce for gold is going to happen. Around, where do you see the price point for silver headed? You mentioned we're at 30 range. Where do you see where it starts to stabilize in the market?
Well, I think, like I said, at this point, price gold, I think silver should be 40 or 45 already, and it's not. I do think, basis this price gold, silver should be higher than its 2 previous highs. It should be more in the $55 to $65 range, which is a double from here. Where, if gold makes it to 3,000, that's a 15% gain from here.
Yeah.
So but
100
like I
versus
said,
30.
Yeah, it disappoints, but then it plays catch up. And there's not a lot of reaction time. When it goes hard. And we've seen that a couple times over the last 10 years. When it makes a move, it tends to move like on a bullet.
Okay. And often, and you and I both understand this, is typically there's leading and lagging indicators on price movement that's happening. I know you've mentioned a few, but I'm wondering if you could talk about just a few more on, in light of this answer, is what are some of those price point leading or lagging indicators that you would recommend people look at just to monitor potential price movements? What would you say?
Well, we get into trading ranges. Right now, silver's got a high of 32.48 just a couple months ago. So that's a trading level. If it breaks that, it's in a technical breakout and it could run hotter. Gold keeps tracking higher. So it's an unusual market where we keep setting higher highs and higher lows. From an external standpoint, right now we're in an easing cycle with the Fed. The Fed's going to start cutting rates. The U.S. economy is still holding up fairly well. Job creation still all right. So we're really not in a real corrective mode yet. But a trigger point that could drive both gold and silver a lot higher is if the Fed really has to react to a sharply weakening economy and really drop rates substantially or sharply. Gold really thrives in that environment. If we go into a more stimulative environment from the Fed where they've got to print money, or they stop QT, that has explosive potential for both gold and silver. Central banks have been record buyers. I would watch, what the central banks are doing. The geopolitical risks that we have are just continuing to grow. Putin is threatening that if we supply the Ukraine with real offensive weapons, that is tantamount to a declaration of war. So there's a lot of things happening right now that are pretty bullish for the metals, and unfortunately are not really that good for the rest of the world. We'll see how they all pan out. But we're in a challenging environment as far as economic and geopolitical stability, with China weak and Europe weak and the U.S. easing right now. So we could get a boost. And these are the kind of things that trigger that sharp rally in metals.
Okay, brilliant. So, transitioning, rounding third base here. If someone came to you and said, Dana, you got 44 years of experience. Let's just say it's me. You got 44 years of experience, man. You've probably seen everything. You've been in up markets, down markets, sideways markets, every kind of market. What would you advise somebody who came to you trying to tap into that 44 years of experience? If you could cut through the noise and get right to the signal, what are 2 or 3 things that you would recommend to someone who asked for your advice? What would you say?
Well, I would say if you're just getting started and you don't own either gold or silver, you should get a position established and, again, have a long-term perspective. You want to understand why you're buying, right? You want to stack and continue to add, like I said earlier. And that would be the point in time where you look at what the relationship between gold and silver is. If silver is still lagging, disproportionately add silver to your position. Or if we get a correction in the gold price, add to that. But this is a great way to save money outside of the dollar.
And I have a question then, because a lot of people, so there's this trade-off of saying, should I own physical gold and silver, or should I just buy GLD and SLV, the ETFs? What would you say, just from your opinion, which one's better, which one's worse, or are you indifferent? What would you suggest?
Well, they're two different things. So the ETFs are very good at harnessing the price movement of gold in a very low friction trading environment. So you can buy and sell ETFs like GLD or SLV, click of a button, and have a low friction to the trade, a very tight buy-sell spread. But they're for harnessing the price movement, trading vehicles. Stacking physical gold and silver is a way to get some of your money out of a depreciating dollar out of the financial system and have private transferable wealth that you can literally hand off to the next generation, your heirs, privately, or move outside of the country if you want to do that. There are ways to do that. So they're two different vehicles. The physical metals do have friction to the transaction because of the buy-sell spread for the physical metal. It's about 4% for gold, and it's about $1 to $2 an ounce for silver, depending upon the item. So that's why these are really not trading vehicles. And it's more important that if you're going to accumulate physical precious metals, that you do so on a long-term horizon.
Brilliant. What else would you suggest as far as an unfair advantage that you can give someone?
Well, you want to work with trusted dealers. I'm a member of the Professional Numismatist Guild. Numismatist is basically a big word for coin nerd. We have about 300 active members in the country today, and we are the leaders in our industry. To become a P&G member, you have to be voted in by the membership. But more importantly, we have to agree to binding arbitration. So if you and I were to have a dispute over a transaction, you wouldn't have to take me to court or vice versa. You could take me to the P&G board of directors who would adjudicate our dispute. So we tend to self-police as a result, and we tend to be the members that have the most wherewithal and experience in the industry. So I would work with trusted dealers, especially professional numismatist guild members, and we're all over the country. This is not a normal market for precious metals right now. As I said, we've got a lot of drivers driving the market. Normally, I would say if you want to try and get a competitive advantage, gold and silver tend to move up and down into trading ranges that are pretty well established with support and resistance, which makes it effective for you. If you can recognize where support and resistance is and you have patience, you can trade off of those either via ETFs or as a way to strategically add to your position or maybe trim your position a little if you'd like to. Most of my 44 years, we've seen gold, move $100 an ounce into a trading range in the last 10, 20 years and stabilize and punch up and down before something drove it above or below that range. That's why having someone who understands, I'm a chartist, so this comes into play quite a lot for me. Right now, gold is breaking that trend by channeling just higher. Silver is still within the range, but it's testing a breakout right now. So you want to look at, where we are in the cycle too. Timing this market is difficult because of what's driving it. And there are, we don't know what's going to happen tomorrow with all of these different factors that are moving the markets. But I would also follow the fundamentals that are driving the metals, right? Look at the value of the dollar versus other currencies. If it's stronger or weaker, that's going to influence the gold price. But understand why the dollar is weakening or strengthening. Look for any potential surges in our debt. That is going to push gold or silver both higher. I'm not sure how our presidential election is going to work out, what that will have to do with our geopolitical conflicts. But the geopolitical environment is certainly driving gold higher right now. And fundamentally, if tracking central bank purchases is really important right now. A couple of months ago, China, I think, did a head feint and said that they hadn't bought any gold for 2 months, and the gold price took about $100 tumble. And then we found out that was false, right? They were driving the price up on themselves, and they're one of the main drivers of the market right now. There's a lot of buying activity in China, both from the central bank and the populace, but it's hard to get transparent numbers out. So if you can follow what's happening with central banks driving the metals buying activity, and the World Gold Council is a great resource for information there. Gold.org is the website. That will give you a competitive advantage.
Awesome, man. So do you think, I'm curious on your thoughts, to see these countries that maybe are falling out of favor, US, China, Russia, like all of these ones are just, they're not getting along as much as I personally would like them to be. But when you see that kind of buying, would you say that some of that is driven by, again, back to that insurance thing, but on war? Because a lot of wars are fought through economics, not just through bombs. Would you say that that's a driver as well, just to protect their own economy and their own currency against an economic war? Or do you see it different?
I think it's enhanced now because of what's happening around the world geopolitically. Originally, when central banks started their net buying in 2011 in earnest, I think that was for a hedge against defaults by other countries, trading partners on an industrial strength level. But now that's changed with the weaponization of the dollar and the rise of the BRICS nations. I don't think that the BRICS nations are going to be able to come up with a unified currency like the euro. That's not going to happen. Remember, it took the euro, I think it was first envisioned in 1978 or 79, and it didn't come into practice until 1999. And one of the things about having the world's reserve currency is power. We've really just exercised that for the first time in the sanctioning of Russia, which is what has shaken these countries. But no central bank wants to cede its monetary authority to another country. And I don't think China or India want to cede the power they have over their own central bank to the other. That's not going to happen. So the dollar's here to stay. But clearly, gold is becoming a de facto world reserve currency again, as evidenced by their buying. That's what all this buying really means. They're finding an alternative to the dollar in the way that it was for 2,500 years of man's existence until the dollar became the world's reserve currency. For most of that time, it was precious metals as the world's reserve currency, and now there's a movement back to it.
Brilliant, man. So I can see so many cool things and not so cool things about going off the fiat currency, and you can imagine these big ships moving tons and tons and megatons of gold around the world. You're like, what could go wrong? The answer is probably a lot. So back in the 1700s, where you get ships sunk and all that stuff with gold and all that, it's a real issue. So hopefully they figure something out as far as the currency and the global economy as well. So that's absolutely awesome. So as we wrap things up, any final remarks, any ways that people can learn more about you or about your company or anything at all?
Well, we do have if you're interested in physical precious metals and you never have started before, we do have a getting started guide that we can send you, which details the basics. As I said, the vanilla, chocolate, strawberry, if it was ice cream, how to buy and sell effectively. If people email me, our company at info@amergold.com. Our website is www.amergold.com. To get the guide, email info@amergold.com. We have live transparent pricing. We have a web store as well. But if you call one of our brokers at 800-613-9323, we're consultative in nature. We really want to help people because it helps us. I found by being honest, straightforward, transparent, it's the best way to go. And we're actually kind of setting the standard for that in our industry over the last 26 years since I started the American Gold Exchange. If any of your clients, want to reach me directly, my email is Dana, D-A-N-A, @amergold.com. And I'm happy to help any of them because I know what a great client base that you have at Making Billions. And I truly want to try and help people. We've got social media. If you Google American Gold Exchange, that's the company in Austin, Texas, you'll find us on YouTube, where I put updates out, on LinkedIn, and our Twitter or X and Instagram handle is AMGoldX, AMGOLDEX.
Brilliant. So just to summarize everything that we talked about, you want to make sure that you have, according to Dana's opinion, about 5% of your net assets being held in gold and silver. And I think you mentioned if it's underweight or overweight based on prices, you might want to look into that as well. Of course, not financial advice, just work with your professional, but this is just opinion based. The second thing that he mentioned is just be strategic in your purposes. Understand the reason why you're doing it. Is it for insurance? Is it upside, cover downside? Just make sure that you have somewhat of an idea of why you're doing it and stick with it. Don't get emotional. Understand that this is a long-term play and just hold the line. And then finally, follow the fundamentals driving gold to all-time highs. You do these things and you too will be well on your way in your pursuit of making billions.